Good afternoon, ladies and gentlemen, and a warm welcome to our HSBC Premier Wealth Webinar. My name is Chloe Giam. It's a great pleasure to be the moderator today. As year 2002 have started off with unexpected twists, rising inflation and investor concern about global growth have cast shadow on this year's economic outlook, especially as the Federal Reserve began tightening monetary policy. And plus, we have got the backdrop of geopolitics and high commodity price. It has been a rather eventful and challenging time for the market, which brings through uncertainty and volatility. How global markets have performed in this mid of high inflation and jittery financial market? How does Asia differentiate from the rest of the world in terms of growth and recovery outlook? Find out more on strategy to navigate market uncertainty with your investment. Now, we are delighted to introduce to you our speaker for today, Mr. David Ng, the Deputy Managing Director and Chief Investment Officer at Affin Hwang Asset Management Berhad. David joined Affin Hwang Asset Management Berhad in 2002 as Head of Equity and assumed the role of Chief Investment Officer in September 2006. In January 2018, he was made Deputy Managing Director while retaining his position and responsibility as Chief Investment Officer. He personified the investment-led culture of the firm. He graduated with a double degree in Bachelor of Commerce, major in accounting, and Bachelor of Law from Monash University in Melbourne, Australia. He is also a chartered financial analyst, chartered holder. He started his career as a large firm before he venturing into fund management with a local-backed fund management house in 1998. Before we begin, we want to make sure we address your questions. Therefore, we have prepared a Q&A box on this platform. You may submit your question anytime, and our speaker will address them at the end of the presentations. Without further ado, I shall now pass the floor to David to begin his presentation. Over to you.
Good evening, everyone. And thank you all for taking the time to join in this call. And I would also like to thank HSBC for having me on this call to share with you our thoughts about the market. As we all know, and maybe not appreciate, but as we all know, it's been a very challenging investment environment, especially since the beginning of the year. But for some of us in Asia, last year was also a challenging environment. But more so this year, when we've seen markets correct quite sharply, be it in the US or in Asia. And unlike previous cycles, the bond markets also had corrected, had sold off this time around on the back of concerns about inflation and rising interest rates. So I'm just going to share with you some of my slides. Gavin will help me run through the slides. And these are some of the things that we're going to be talking about. As we all know, and as I said, expectations for this year, for various reasons, they have turned out very differently to what we and a lot of investors expected. Inflationary pressures remain high, and this was made worse by the Ukraine-Russian war. At the beginning of this year as well, there was high expectations of China reopening, because China, as we all know, was first in and first out in terms of COVID. But the expectations of China reopening looks like it's been misplaced, as the Chinese government is still averse to reopening. Although of late, there have been some tentative signs of them being a little bit more pragmatic, as they are beginning to realize that the economic cost is high. But until they fully reopen or they embark on greater reopening, the supply chain disruptions emanating out of China, that continues to amplify and add pressure to inflation. The other thing that we are all also conscious of is that the Federal Reserve and other central banks around the world are raising interest rates. The Federal Reserve has started its rate hike cycle. Back home here in Malaysia, we saw Bank Negara a couple of weeks ago, also surprised with a rate hike. Countries such as India, Australia, they've also started hiking interest rates. In addition to that, the Fed is also embarking on what is known as tapering. So post-COVID, there was a lot of QE done, and now they are looking to reverse and unwind some of that QE. So that's in a nutshell what's been happening, and markets have sold off as a result because markets started from a point which was expensive. It has derated, and I'll share with you later what my thoughts are about the valuations of the market. So now I'll take you through the slides. Basically, think of this as evaluating the markets through three factors, right? And when we look at markets, we look at number one, the fundamentals, number two, valuations, and third is technicals. So starting off with the fundamentals, very clear for everyone to see, growth is slowing. 2022 GDP growth across all regions will be slowing. And that is no surprise because as we all know, growth is measured generally on a year-on-year basis. And we all know that 2021 was a very strong year in terms of GDP growth because it was a year of recovery from a very poor 2020, where we were affected by COVID, with the lockdowns and all. The key is how much would growth decelerate? So at the start of the year, there was the consensus thinking was, yes, growth would slow down, but it would slow down to a level that is still above trend. Right? So still very strong growth, strong enough to support the markets. But of late, we are starting to see doubts creep in as to whether growth will actually slow down more than what was initially expected at the beginning of the year. And moving on to the next slide on inflation. This is, to me, this is what I would call the biggest elephant in the room, right? Because inflation plays a big part in investments because high inflation, which we're currently experiencing, high inflation acts as a tax on consumers. It affects consumption, which then drives the economy. Although in Malaysia, our official CPI inflation is only, I think, 2+%. We all know on the ground it is higher. We feel the pinch. What more in countries such as the US, where inflation is, the last reading was 8.3%. So because wages have not kept pace with inflation, 8.3% headline inflation rate, that definitely affects the spending ability of US consumers. And it's not just the US, we're seeing that all across the world. And as I said, a lot of it is due to the spike up in commodities prices as a result of the Ukraine war. Also the supply chain disruptions. Although on that note, as economies reopen, and more crucially, we need China to reopen, then the supply chain disruptions will start to taper off. We start to see less bottlenecks in the entire chain. And combined with the fact that the demand for goods should start to slow down, we expect to see inflation start to moderate. And this is crucial for us. And to be very honest with you, it is still too early to call. We know that inflation should start to peak and come down. Where there's uncertainty is whether inflation remains higher for longer, or because of base year effects as we move through into 2023, inflation numbers start to come down. And the key thing for us to watch, especially in the US, is number one, wages. If wage inflation continues to rise and pick up, if rental inflation in the US continues to rise, then that may mean that inflation stays higher for longer. It will come down from the 8%, but whether it settles at 5 or 4 or 3%, it's still too early to call. Our sense is that it should start to move closer to at least the 4% level, move down to the 4%, if not lower, as we move into 2023. Because we think wage pressures should also start to dissipate. We are hearing and reading about companies in the US reducing their hiring, laying off workers because of demand softening. So you can imagine that for the central bank, this is a very delicate situation. It complicates matters because on the one hand, you've got high inflation. On the other hand, you also have a situation where growth is slowing down. And the central banks really don't know. They want growth to slow down, but they do not want growth to slow down too drastically, right? Such that it leads into a recession. And I don't envy their position. I don't envy their job. This is a very delicate balance that they need to try to navigate through. And for the central banks around the world, especially the Federal Reserve, the key mandate for central banks is about price stability. So they will want to slow growth if that is required to bring down inflation. Because the last thing that any central banker would want is to lose their credibility. If inflation starts to run away and stays high, that's when they lose credibility. So more important from a longer term perspective, they would be prepared to sacrifice short-term growth to ensure long-term sustainability. But as I said, this is a delicate balancing act, trying to engineer a soft landing. It's never easy. So as I said earlier as well, the expectations, our expectations is that even if oil prices, for example, stay at current levels, as we move through into 2023, inflation should taper off to about the 3 to 4% level, purely because of year-on-year base effects, right? Because inflation measures the rate of change, and if prices all stay stagnant at current levels, 2023, you start to see the headline inflation start to come off. Moving on to the next slide, just to share with you an example of what the Fed is doing. The Federal Reserve, I think they were caught off guard as well. They, for the longest time last year, up till December last year, their view was that inflation was transitory, meaning it's going to be temporary as economies reopen and supply chain issues get resolved, as consumers shift away from consuming goods to consuming services. Their expectations was that inflation would taper off this year. And initially they would have, I think they thought that by January of this year, inflation would have peaked. But then we all know that the war happened. And although Ukraine or Russia is not a big, they're not big economies in terms of GDP contribution to the world. Unfortunately, for markets and for global economies, they are big actors or players in commodities, be it natural gas, be it gold, be it wheat, and some other metals commodities. So that has led to spikes in commodities prices, which has resulted in inflation rising further than what the Fed originally expected. As we speak now, the Federal Funds Reserve rate is at 1%. The expectations that they have communicated is that there will be another 1.75% of increases from now until the end of the year, which would lead to an end figure of 2.75%. Now, 2.75% is not exceptionally high, but in a world where there is a lot of debt, if you look at the world today, it's a highly financialized world where debt levels are high. 2.75%, well, absolutely not high. It is sufficient to act as a brake to slow down global growth, which is what the Fed wants, without triggering a recession. More importantly, as a result of that, is we have seen a lot of more expensive growth stocks, speculative growth stocks whose profits are way out into the future. They have sold off very, very sharply. But I'd also like to highlight that it is a dynamic function for the Federal Reserve. And in the last 1-2 days, there are some members of the Federal Reserve Committee who think that they should just raise rates to about 2.25% and then wait and see to see how the economies handle the higher interest rates. If this were to happen, this would be a positive surprise. And in my view, this would be good for bonds because inflation starts to taper off, growth slows down enough for inflation to come down, but not such that it leads to a recession. So my view is in this kind of environment, if this is what we're expecting, then fixed income is probably an area that we should start thinking about scaling into in a gradual way, because as I said, there's still a lot of uncertainties. For equities, I'd still be a little bit more patient because valuations have derated. But I think earnings has room to fall further, or earnings forecast has room to fall further. Now, moving on to the next slide on the US dollar. If there is one factor which has proven to have a very high inverse correlation with how Asian markets perform, it is the US dollar. A strong US dollar environment typically means emerging markets or Asian stock markets underperform. And as we can see here, the US dollar has been very strong because the US central bank is the one that's been more aggressive on interest rate hikes or potential interest rate hikes. And in the overall scheme of things, the US economy still remains one of the stronger economies amongst the major economies in the world. So for us, we sense that the US dollar is getting to, it should start to peak soon. As growth starts to slow down in the US, we should start to see the US dollar tapering out. And whether it starts to weaken, again, I'm sorry to say this, it's too early to call. In the last week or so, it's actually weakened against the euro, for example. But this is a key indicator for us to watch. If US dollar starts to weaken, that will be a tailwind for emerging markets. And that is when we would want to be more aggressive with deploying money into the Asian markets. Moving on to the next slide, which is on China. I think it is very clear for all to see that the impact of the lockdowns has been drastic. Consumption, economic activity in China, even domestically, right? That has been affected. But as I said earlier, there's also potential good news with the COVID situation improving and other cities, for example, Beijing, employing a different, more localized method of COVID controls. In contrast to what we had seen in Shanghai, we could be seeing some positive news or some light at the end of the tunnel for China, provided there's no fresh outbreaks, because the Chinese authorities that have come so far, they still are adamant about maintaining zero COVID policy. So if we were to see a breakout of COVID cases, I don't discount the possibility that they would move to lockdowns again, although it may be more targeted. The other thing to note about China on the next slide is that they understand and they are feeling the heat because of these lockdowns. The cost to the economy is getting to be quite heavy to bear. You never really know what the sense or the sentiment on the ground is in China, but I can imagine that there are people who are dissatisfied because they're not getting employed, they're not being able to work, and it affects their livelihood. So China has finally decided over the past couple of months, actually, in drips and drabs, they've announced policy measures to try to stimulate the economy. On that point as well, it's a valid point. They can announce, they can give vouchers for people to go out to consume. They announce subsidies for car purchases. But if there's lockdowns, these stimulus measures will not be as effective, because if you can't go out, you're not going to spend. So the key thing for me is, in terms of priority, COVID has to be brought under control in China. They have to lift their lockdowns, combined with some of these policies which they've announced. That hopefully leads to improvement in consumer sentiment and economic activity can pick up. Other examples of what the Chinese government has done is last week they announced to cut mortgage rates by 35 basis points. They have announced measures to raise bonds for construction, for infrastructure. So that should hopefully stimulate spending in the infrastructure and construction space. These are the things that China has done. I hope that they will step away from zero COVID policy. One of the other key things that we are going to look out for is if they come up with their own version of a more effective vaccine. There is a sense that the Sinovac vaccine is not as effective, which is why they are more hesitant to reopen the economy fully. Moving on to ASEAN, closer to home. ASEAN has been more resilient, and when I talk about resilient, the markets have outperformed relatively. They're not in positive territory, except maybe Indonesia marginally. But compared to the North Asian markets, ASEAN has been more resilient. Right? And the reasons are quite obvious. For example, in Indonesia, it's due to high commodities prices, not just CPO, but Indonesia is also home to other metals such as copper, nickel, they have coal. So the high prices of such commodities is a positive for Indonesia. For Malaysia, it's CPO. We benefit from that. And marginally, we also do benefit from higher oil prices. And the good thing about high commodities prices in such economies is that they will lead to a positive multiplier effect on domestic consumption, which is why some of these themes or some of these stocks to us, we think stand to benefit from not just high commodities prices, but also, as you can see, a reopening of the economy. Moving on to the next slide. This is what I was referring to. You can see coal prices have skyrocketed. CPO prices have also moved very sharply higher. And on to the next slide. On reopening as well, a lot of countries in ASEAN do benefit from tourism. Thailand, of course, is the clearest example that comes to mind. But countries such as Singapore, countries such as Indonesia as well do benefit from tourism. So this is a theme, reopening theme, that we think can be exploited to try to generate some returns if you're investing in stocks, or even if you're investing in bonds. So for example, we do like Indonesian bonds because we think the Indonesian economy is very robust. If you look at Indonesia today compared to what it was in 2008, you look at Indonesia today compared to what it was during the ASEAN or Asian financial crisis, the financials or the balance sheet of Indonesia is a lot healthier today than what it was. And finally, on to earnings. Next slide. This is why I talked earlier about being a little bit more patient. Prices or stock prices have come down. Bond prices have also come down. Growth slows down. I shared earlier, I think bonds is an asset class that we can start thinking about deploying some money. But for equities, although valuations have come down, when we invest in equities, we typically invest into stocks because of their earnings growth. And in my opinion, I think earnings will still need to be revised downwards. The chart that we've shown here is estimates by Morgan Stanley for earnings in Asia, for the US as well, which I'm not covering here, but I also expect that the analyst community in the US would have to cut their earnings forecast for the rest of the year. So again, I advocate for equities to be more patient, keep the firepower on the sidelines. If you want to invest, if you're the sort that has a long-term investment horizon, you're prepared to do dollar cost averaging, then fine. But be very gradual. This is not the time to be deploying big monies into the equities market yet. That's just my opinion. Things can change very quickly, but personally, that is an approach I would advocate. Next slide. So what I've shared in the previous slides is about the fundamentals. I've talked about central banks. I've talked about inflation, earnings, and the economy. And now we move on to the second factor that we look at, and that is valuations. Because ultimately, when you are investing into an asset class, when you're making an investment, you do want to look at the fundamentals. But very crucially as well, you want to look at what you're paying for it. And that's where valuations come into the picture. Right? You can have a very good asset or very good investment, but if you're paying a very high valuation for it, then your probability of making money in the nearer term is a lot lower than if valuations were cheap. So this is where there's a little bit of good news, valuations. The growth part is missing. I think growth will slow down, but valuations are getting attractive. You can see on this chart, I'll just point to an example of China. China, as you know, or you may not know, from the peak last year to today, the MSCI China index is actually down by about 55%. So that's been a very huge drawdown in the stock market. But the same applies for a lot of other Asian or emerging markets. Look at Japan, look at MSCI EM. EM stands for emerging markets. They have all come down. Markets have come down and valuations have derated. Can valuations move lower? Yes, I think it can. But what I'm trying to say here is that valuations, for example, MSCI China has come down to about 11 times. In previous cycles, it's bottom at 9.5 or 10 times P. So we are getting closer to the trough that we've seen in previous cycles. And from that perspective, if you are willing to nibble a little bit, I think it is okay. Go slow. Your margin of safety today is better than what it was 6 months ago or 12 months ago because valuations have come down. A lot of it also depends on your risk appetite. Markets will definitely be volatile. This environment that we're facing today is very different to a normal cycle. You've got to contend with central bank policies, you've got to contend with the war, you've got to contend with China's policies. So the volatility is going to be very high. We're lurching from one event to another. That's why I advocate being gradual in your approach if you wanted to invest into equities. And finally, the third factor that we think about, we look at is technicals. Again, on technicals, or what we call positioning, right? Moving on to the slide. We can see that I don't think it's exhausted yet. I don't think it's done, but we are at least seeing some froth taken out of the market. So valuations have come down and technicals as well. When we look at fund managers positioning, there have been fund managers are essentially all very are feeling bearish. They're not highly invested. They're holding a lot of cash. We have started to see outflows from global equity funds. So if you're taking a contrarian approach, you would want to see further outflows until we come to a point where we believe that selling exhaustion has taken place. So whoever wants to sell, whatever they want to sell, they have sold. And that would be a prime environment to then take more risks to get back into the markets. And on this chart here, you can see it's been 6 weeks of outflows from global equity funds. The outflows over the last 6 weeks has totaled $46 billion US. And just to give you a sense of comparison, this 46 billion is about half of the inflows that we saw go into global equity funds post the March 2020 COVID episode. Remember at that point in time, COVID, everybody thought it was going to be the end of the world. And then the central banks, governments all around the world stepped up both fiscal and monetary policy. And that led to huge inflows of monies into equity funds. So that total about 91 billion. The outflows we've seen in the recent 6 weeks is 46 billion. So that's about half gone, which is a good thing. What we want to see being, if you have a contrarian mindset, you want to see further outflows. Gets to a point where we think it makes it safer to deploy monies back into the markets. For bonds as well, we have seen huge outflows in bonds. Again, in previous cycles, when equities are not doing well, bonds give you an alternative asset class to get into, because typically equities don't do well. It's because growth is slowing down or we go into a recession. But then that also means inflation is coming down. And when inflation is coming down, that is an environment where bonds perform. This time around in 2020 and 21, 2022, it's a cycle where if you had a balanced approach where you invested in both bonds and equities, both asset classes have not done well because inflation is high, bonds don't do well, and growth is slowing down, equities don't do well. So bonds have also seen a large amount of outflows. But as I shared earlier, and I think this would be a key takeaway for most of us here on this call, if we think the economy slows down and inflation starts to taper off, then I think bonds or bond funds is an asset class that you should start thinking about. Another thing I'd like to share, if you look at the chart on the right, when you look at the US markets, I use the US markets because I think those of us who watch the markets, a lot of us look at what's happening in the US. Well, the main indices, whether it's the S&P 500 or the NASDAQ, they're only down about, I say only, I don't mean to dismiss the severity of it, but they're only down about 18 to 25%. But if you were to actually look beneath the index levels, a lot of the, what we call the profitless or speculative growth names, they're actually corrected by anywhere between 60 to 90%, right? As interest rates have risen and their earnings deteriorate further. A lot of these names rose spectacularly post-COVID because, as I shared earlier, there was a lot of liquidity being pumped into the markets by by central banks. There was a lot of retail participation in the markets, and they like to go for the sexy growth names, even though they're not profitable. That led to that spectacular rise that you can see in the chart here. But now that the bubble has popped, a lot of these names have corrected very, very sharply. Another thing to note on positioning or technicals, funds have been reducing exposure to markets with, this is just a sampling of Asian funds. Cash levels are at the highest in 2 years, although we have seen previous cycles where cash levels were higher, but this is just an Asian example. Another estimate that we track, which is on global fund managers, it shows that global fund managers are holding levels of cash which are the highest since 9/11. 9/11 is, we're talking about the Twin Towers episode, that's in 2001. So in terms of positioning, this is, I would take it as a positive. Positioning is quite bearish already. It's not like fund managers are fully invested, so there's a lot of selling to do. Currently, fund managers are very bearishly positioned. We're starting to see outflows from funds, and quite a lot of outflows already has taken place. So I would say, if I were to make a guess for US, we're probably 50 to 70% done. For Asian markets, contingent on, let's say, the US dollar starting to weaken or stop appreciating, I would say for Asian markets, we are 2/3 or maybe 3/4 of the way there already. The other indicator that we like to track, and that some of you may have seen before if you have attended any of our presentations, this is a chart we use from Bank of America. This is what is known as the bull bear indicator. And anything below 2 in normal environments acts as a signal to be contrarian to start buying. If you look at the chart here, you can see that that figure is now at 1.5%. So if you were, again, if you have a lot of firepower, it is okay to start getting your toes wet. Bear in mind, 1.5, it can go to 0. We saw it go to 0 during the COVID period, March, April, some parts of May in 2020, where everybody was so bearish already that it was time to get bullish. At 1.5, a lot of people are bearish already, although I think there's still room for it to move lower, purely because of the fact that I expect, number one, earnings to be revised downwards, and number two, I expect some further outflows still from equity or bond funds. But just another takeaway from this is that we are quite close to, the markets being very bearish already, that it is possibly time to start thinking about what you want to invest in. Even if you don't want to invest now, it's time to start thinking that, what kind of exposure you want, maybe 6 months down the road, 9 months down the road. You have to keep in mind that corrections, stock market corrections that we've seen, they are always a function of both price and time. So price damage has occurred because price damage takes into account the direction of growth, which I shared earlier. Growth is decelerating, but it will take time for the severity to be evaluated and digested. And that's why I continue to advocate patience. The severity that we need to evaluate is to see how much earnings has to be revised downwards, how much global economic growth has to be revised downwards, the impact on consumption, and whatnot, and throw into the mix what's happening in Ukraine and China. It makes things a lot more difficult to juggle. So again, one key takeaway is patience. What I can say though, at this kind of a level on the bull bear indicator, 1.5, or as it gets closer to 1, it suggests that markets could be due for a bounce, what is known as a bear market rally. But do I think this is the ultimate bottom? My own sense is no. You could see a bear market rally, but markets would then move lower after that. Moving on to the next slide, I will skip this. Just very quickly on this chart, we can see in the environment that we're faced with now, the growth type names have struggled. What has done well is the defensive, so high dividend stocks, consumer staples, those whose businesses will be less impacted by the global economic environment. those companies who pay decent and rising dividends, they will outperform. And if you look at this chart very clearly, the defensives have outperformed the more growth-orientated sectors of the market. Now, on the next slide, in terms of strategy and what we're thinking about, I think if you've been listening to me over the past 20 minutes or so, I hope you would gather that number one, be patient. Number two, bonds is something to look at. But what I'm going to share with you on this slide is what we're looking for in terms of strategy. What would be some of the key data points or key factors that we're monitoring before we decide to make a bigger shift in terms of taking risk. Number one, we definitely want to see a move lower in inflation. As I said, inflation, to my mind, has peaked or is almost there. It will start to move lower, but where time will tell is whether it moves down to the 3-4% range or it stays at a sticky high level, because that determines whether bonds is a good or a great asset class to get into. Secondly, if we start to see inflation moderating, the benefit of that is also central banks become less hawkish. What does hawkish mean? Hawkish is what currently central banks are, how they're behaving. They're looking to raise interest rates because they want to snuff out inflation. If inflation poses less of an issue, they can be less hawkish. So they can raise interest rates maybe 3-4 more times and then stay there. And that will be welcomed by markets. Thirdly, of course, we want to see China reopen. China is a big economic actor, especially in this part of the world and globally as part of the global supply chain. So China, they have their Congress in October. It's very hard to try to predict what the Chinese leadership is going to do. But hopefully by then they would do away with their zero COVID policy, step up their vaccinations, hopefully bring in or they are able to then produce a stronger vaccine and they can do away and start living with COVID just like the rest of us are doing. And finally, of course, resolution to Russia-Ukraine. Wars are always hard to predict and legislate. Everybody, not so much today, but initially when the war happened, everybody was trying to become an expert on war. The truth is, and I'll be very frank with you, I don't know how long it's going to last. I don't know whether it's going to de-escalate or escalate. But if I were to hazard a guess, and if you think about from a politician's standpoint, I think there must come a time where the leadership of Ukraine and also in the US, where they may decide that, look, let's try to save face for everyone, carve out the territories that Russia wants, and both parties can claim victory. From the US standpoint, Joe Biden, as he moves into the midterm elections, if inflation is still very sticky, commodities prices are very high, and the American citizens are struggling with their daily consumption needs, then it may make sense for him to, from the background, he is a puppet master, the Americans, he may then try to drive through a settlement between Russia and Ukraine. And again, that would be very positive for risk sentiment. So currently, there are these little fires raging across the financial markets. It is easy, as a professional fund manager as well, it's easy to get caught up in the day-to-day negatives that these fires bring, because you see markets down, 1 day up, 2 days down, and the severity of the pullbacks has been quite great. But another thing I would like you to remember as we leave this call is to remember that after this flame subside, there's always a process of rejuvenation. So if some of these things that I shared earlier start to take place, there will be a beginning of another cycle. What I can tell you though, it is impossible to time the bottom. What I can guarantee you though is that there will be one, because there always is a bottom. And with that, I end my presentation proper, and I open the floor to questions. Thank you.
Thank you, David, for your insightful sharing. Well, I'm pretty excited to start the Q&A session, as I see quite a number of interesting questions in our Q&A box. Let us begin with our first question. Mr. David, what is your outlook for what you think for the outlook for semiconductor, as given the Nasdaq have been quite negatively so for the past few months?
Okay, very tough question. I won't comment on the stocks specifically listed here. My own view on semiconductors is that they are good companies. They are in a good business segment because, as you know, we are in an era where data is a new oil, right? So you've got cloud computing, you've got Internet of Things. So the long-term structural drivers for the demand of semiconductors remains intact. But as I shared earlier, fundamentals is one thing, valuations is another. So some of these companies, I won't use the examples here because these are Malaysian names. Some of you may be linked to these companies, but let's use an example of a US name, a stock called NVIDIA. Great company, definitely exposed to the right long-term theme, but share price has halved. And why has it halved? Is it because it's a bad company? No, it's because valuations were too high. And as interest rates rise, because I'm getting a little bit technical, but a lot of us look at valuations just normally we use price to earnings, but there's another way of valuing companies, and that's based on discounted cash flows. So discounted cash flows is discounted using interest rates or risk-free rate. And as you discount by higher and higher interest rates, the valuation of the companies become lower, or the fair valuation of companies become lower. So the short answer to your question is good companies, yes, in economic slowdown, they are cyclical as well as demand. As you know, smartphone sales have declined, with the exception of maybe Apple. But if you look at the other Google, Android type phones, sales are weak. Analysts have had to revise down their forecast. So the semicon companies will be exposed to that slowdown in their end consumers' demand as well. So I am a little bit cautious on the semiconductor names. Some of the names that we track in Korea, they have also come off. They are getting to attractive levels where we are going to be more alert, trying to buy it at slightly lower levels from where we are currently. But in the nearer term, I'm still a little bit cautious on the demand side and on valuations on some of these companies.
Thank you, David. Then we'll proceed to the next question. Should I wait for the right time to invest?
Timing, as I said, timing the markets is very high, but if you're not trying to be a hero and try to time the top and the bottom, then a good framework to invest is always looking at, I think, over big cycles, you always want to look at valuations, right? And my thoughts on valuations, as I shared earlier, for the US market, I think there is further room for valuations to get cheaper. But for Asian markets, provided lockdowns are lifted in China and whatnot, valuations are getting to what I would deem as attractive levels. But as I repeated many times in my presentation proper, I would advocate patience. When it comes to equities, if you're thinking about equities, I would advocate patience. If you want to do it gradually, stagger your investments in. It's not the time to go big. That's my answer.
Thank you, David. Then we will proceed to the next question. As investor, which sector and region that we shall focus on for now?
Sorry, I didn't hear. Which region?
Region or sector we should focus, during this market uncertainty.
In terms of sector, clearly the sector that has done well this year is commodities. Within Asia, a lot of the big markets don't have that exposure to commodities. Of course, Malaysia we have, Indonesia we have plantations, Indonesia have got some metals companies, and they have done well. But Asia, as in general, we are net commodities importers, which is why it has affected Asian economies and Asian markets. But if you can find something in the commodity space. I think commodities is a place where where there's still potential upside. And you also have to be very selective, because if growth slows down, demand for commodities will also slow down. So you have to look at the supply side of commodities and where supply constrained. I think CPO, because there's no new land clearance. I think oil, because of ESG and whatnot, there's been a lack of investment into oil exploration. I think these commodities can stay higher for longer. But aside from that sector, just going back to the question on semiconductors, I don't think it's now. I think you can be patient and wait for lower levels. I think semiconductors or tech is still the space you want to get back into when the timing is right, even though I said it's hard to time. As for EM and DM, again, I'm sorry if I appear as though I don't want to directly answer the question, but for me as an investor and putting on a wealth of financial advisor hat, I do not like it to be a binary decision, right? What do I mean by that? I mean, it does not have to be, oh, you can only invest in EM or you can only choose DM. I would still want to spread it out a little bit. EM is very cyclical, so as things get worse and valuations get cheaper, and if you think there's going to be a rejuvenation, then yes, you want to have some exposure to EM, especially if China opens up, because Chinese valuations are cheap. But at the same time, DM, especially in the US, they are the front runners or forerunners of a lot of companies with what I call very strong moat, right? And what are companies with very strong moat? These are companies with very sticky consumer base, sticky clients, very strong branding. It's hard for their moat or for their uniqueness to be competed away. And that's why I also think that you want to have exposure to developed markets, especially in the US, where you have some of these names. And even in Europe, there are some companies which have got very, very strong branding. Once the economy recovers, once consumption starts to pick up, these companies are actually trading at quite attractive valuations. I'm not asking you to go out and buy, but one example for the ladies out there, you all would know your Louis Vuittons and whatnot. The listed company that owns Louis Vuitton is in France. So share price has come down because obviously business will be affected. But these are companies that at the right price point you buy and you can hold for long term. So the answer is both. More upside if it's a cyclical recovery, then emerging markets typically provides you that bigger bounce initially. But I'd still advocate having both.
Thank you, David. Well, ladies and gentlemen, I'm afraid we just have a few minutes to spare for one final question. Mr. David, so the final questions that the investor would like to know is, for lately, many investors confident about China as a source of stability have been shaken. How should we read recent policy move made by China itself? Yeah. How for the investors should position in their investment portfolio?
I'll be lying if I say I know what China's next moves is going to be, because I think no one really knows except Xi Jinping and his inner circle. Right? The way I look at China, and I've been wrong. Okay, I'll be the first to admit that I've been wrong, because I thought that China will reopen this year, because I put on a logical thinking cap, and I thought Congress is in October. He'd want to start the Congress with an economy that is robust and healthy, and the people are happy, they got jobs and earning a good living and all that. But it looks like his thinking is very different. So I was wrong, but our overall exposure to China for Asian funds is actually quite significantly below the benchmark weight. In spite of that, we are affected because we were positioning for reopening. Right? My thoughts on China and some segments of the Chinese stock market is that, I hope these are not famous last words, my thoughts is it's too cheap to aggressively sell. If you want to lighten up a little bit because you can't stomach the volatility, let's say if you're exposure to Chinese funds, you just can't take it. You just want to sleep a little bit easier at night. Then by all means lighten up. At the end of the day, it's our own well-being that matters most. But just strictly from a, let's say, analytical perspective, and again, I like to, not nice to say it, but I've been wrong. From just analytical perspective, I think valuations are a little bit too cheap already. But I said that 15% ago, 20% ago, right? So that's my caveat.
Okay, thank you, David. Once again, thank you, David, for your great sharing. So it's
Most welcome.
It's a pleasure having you with us today, Mr. David. Well, ladies and gentlemen, that concludes our webinar. We hope today's session gives you a better insight and ideas on how to position your investment portfolio to benefit from the current market environment. I am sorry we are not able to cover all questions. Please feel free to reach out to your relationship manager to learn the key investment team for your investment needs. You could also gain market insight offered through our HSBC Wealth Insight platform. We look forward to seeing you again for our coming webinar. Until then, do stay safe and take care. Thank you for joining us and have a pleasant afternoon. Bye, everyone. Thank you.